think there's two ways to think about that. First of all, it doesn't affect them too much because banks aren't exporters. So if I think about other industries in Europe, those are clearly much more affected on a sort of day one basis or level one basis. Banks, there's a second order implication. Who have you lent to? How are those companies performing? And what's the likelihood that those companies may get into financial difficulties and start to struggle in terms of paying back on time? So if you think about the risk around tariffs, and to be clear, after April 2nd, the sector sold off quite meaningfully. So the market was trying to price in some risk. We did our own scenario analysis. If you think about a slightly more dovish response from the ECB, lower rates in the reaction, slightly less economic activity, growth forecasts coming down, and at the same time, credit costs getting a little bit higher. We saw credit spreads widen. All of those things mean you could have a situation where you have a double-digit earnings downgrade cycle, and the sector sold off. So as we look forward, I think obviously the market more broadly, equities in the US and Europe have priced a much more benign outcome on tariffs. But I think that is still at the back of people's minds as we look into July. What could that mean for the macro in Europe? And therefore, by definition, what could that mean for the banks?
Let's talk ECB, because clearly the ECB more or less signaled that this is it with rate cutting at their last session. Perhaps there's another one coming. But what does this rate level mean for banks? Can they maintain their strong earning momentum?
Yeah, I think, our economists assume there's a pause in July. We have another one in September, another cut. Yeah. But like you said, we're closer to the end of the story than the beginning of the story in terms of rate cuts. There's a lot of discussion around what's the sweet spot for rates for European banks. For what it's worth, I think in general that sweet spot is sort of 1.5 to 2.5. A long way above 2.5, you start to squeeze some of that later cycle credit exposure just because rates are too high for too long. So think about consumer finance or commercial real estate in particular. Too far down, and it's the reverse of what happened on the way up. Banks aren't able to cut their funding cost by much anymore. Now, it's very difficult to know what that point of non-linearity is. For what it's worth, we think it's probably about a 1% policy rate. At that point, when you really start to get too low, banks aren't able to pass on the cuts to their funding base, which in Europe is retail savers. And as a result, they wear more of the cuts themselves. So that sweet spot there is where we are today. And that sort of feeds into why we think we had this better for longer backdrop across the sector.
Of course, next to the lending business, investment banking is important for most banks, at least for the big ones. Going into the year, we were very confident about IPOs coming. M&A is going to be back, but we don't see a lot. So what do you think? Second half?
So I think it's a big topic in everyone's minds to start with. I think there are parts of the market which are signaling some accommodating sort of measures, I think, are coming through. What we're hearing, we had some panel discussions yesterday here at the conference, particularly when you look at IPOs. IPOs are actually trading reasonably well in the United States. There is precedent in this market. When you dial into what are the specific windows, because of the sort of restrictions around when you can and can't list, when your accounts go out of date, etc., there are a limited number of windows, finite windows, and it feels like something's been happening in each of those windows in recent months and recent quarters. So I think if we look at our own estimates, we are still assuming there's a bit of a pickup in the second half of this year, and then into 2026, there's a broader pickup in activity levels.